Welcome to the Stay the Markets podcast. I'm Paul Rodriguez of thinktrading.com.
I'm Tim Price of pricevaluepartners.com.
And our very special guest is David Hunter. David Hunter, welcome to the show.
Oh, thank you, Paul.
So, between us, we've probably got over, I would say, 120 years worth of market experience, but you're the daddy here with 50 years. I feel like a newbie.
A spring chicken.
Yes, exactly.
Yeah, it's one of the good sides of being old, I guess, is you have experience. But otherwise, yeah, we're the old guys.
Absolutely. So you started out in the markets in 1973. What got you involved in the markets in the first place?
Sure. Yeah, I was a finance major in college, and back then, you're my contemporary, so I think you understand this. But it was a rarity when I entered college. Most people were entering college to avoid the draft, and they didn't really know what they wanted to do. So they were what we called back then hearts and flowers majors, mostly liberal arts. I decided right out of high school I wanted to major in finance. It interested me, and so 4 years of business and finance background, and I guess probably halfway through or junior year, I decided I really wanted to get into the investment field. So, I knew pretty early on, and really once I got in there, I never wavered. It was, it's clearly what I wanted. So,
what was the composition of that course, David? I mean, the reason I ask is because my brother, who is singly responsible for the global financial crisis, read economics at Cambridge, so he was ground zero. It was his fault. But what kind of course was it? I mean, I'm a fan of Austrian school economics, but was it Keynesian or classical? What was the bias?
Yeah, well, it was finance, so it was really more away from the economics. I was a finance major, economics minor, I guess, and then did an MBA with finance emphasis also. But yeah, my economics in college in undergrad was pretty straightforward. You did your micro and macro and a few other courses. But it was in graduate school where I was fortunate. One of my courses was taught by a university. I went to DePaul in Chicago. One of the courses was taught by a professor who was from the University of Chicago, and it was a macro course. And so even though he said, my whole job is to make sure you don't know whether I'm a Keynesian or a monetarist, to teach you both sides. But he was so good at it. It was, I basically am a monetarist at heart. So,
did you find that education actually helped you, or did you have to develop your own methods? From what I understand, you use multiple forms of analysis. And if I could just tie this question into it, when did you feel most comfortable with your overall investment thesis? I don't know whether anybody ever feels 100% comfortable, but
right.
Feel like the pieces were together and you were confident in your ability to predict the markets in a way that worked for you.
Yeah, certainly the education you get with all the courses in finance, with all the courses in accounting and economics, you come in with certainly a base to work off of, but really investments is something you learn on the job. You look back and the things you thought you knew coming in, and you didn't know squat. So it's really a cumulative effort. I feel my first probably few years, you're just kind of going along. You're impressed by what you hear from the so-called experts, etc. But I was a contrarian pretty early on. I think it comes naturally to me. So I coming into 1973, it was a top of the Nifty 50 market, and so I very quickly then got into the 73, 74 bear market. So I learned very early on the importance of risk management, capital preservation. And I think that served me very well through the years. again, I'm naturally contrarian. I gravitated to the value side of investing pretty fast. And that kind of fit in with, looking out for your downside as well as your upside returns.
How much of the current market environment feels, with the Magnificent Seven, feels like the top of the Nifty 50?
Not really yet, at all. That was I don't know if you guys have ever studied that period, but it was pretty amazing. Everybody that managed, most of the pension money that was managed back then was concentrated in the New York banks. So the managers all went to lunch together, all heard the same stories together. They got caught in obviously the one decision. The whole story was it's a one decision stock. These are all big blue chip, American companies that are the backbone of the economy, and you only have to know, you only have to buy them. You don't have to worry about selling them. And that's what drove the Nifty 50 to the top. There are some similarities, certainly, in terms of this thing is getting longer in the tooth, and we're at the end of what I call a 41-year secular bull market that started back in 1982. So even though I have, people know that I'm out there calling for 7,000 on the S&P, so still, 40% away. I think that's coming in a matter of months. So we're getting to the end of a 41-year bull market. So from that standpoint, yeah, it's similar. But the makeup, I'm not one of those that believes the market's going to stay narrow right to the top. I've been saying for a while now that the last stages of this are going to be somewhat unusual, and that's the typical way it goes, is as you go towards the top, markets narrow. I think this thing's going to broaden out, and you're going to actually have a broad rally into the top.
So what makes you feel that we still have more to go, going back? You said, was it from the 80s? So it started in the 80s.
Right.
Why in the 80s, and why do you feel we're now nearing the end? Because there's been plenty of times when one could have said we've hit the end of this, and the markets just kept going up. 2008 was a big one. 2020 was another one. Of course, the big one hasn't happened, but what makes you think that the next big correction will be the correction?
Right. Yeah. The reason I dated back to 82 is that's really the start of the disinflationary trend that we got. We peaked inflation out at just over 20%, and it started coming down gradually and then faster later on in the decades to come. But it basically is what drove us from, I remember the Dow back then. I don't remember what the S&P was at in August of 1982, but the Dow was bottomed, I think, at 782 or 780, somewhere around there. And of course, we've come to 35,000 plus. So what drove that move was certainly earnings, but the biggest driver was the fact that as disinflation came into being, inflation came down, interest rates followed inflation down, and we went from 15% long bond down to, or 15% 10-year down to almost zero. So PE multiples are the inverse of that. So we've had this big expansion of PE multiples. So that kind of is the way I see the whole secular move, is that it was driven by disinflation, and that we're coming to the end of that, one way or the other. We obviously had this ratcheting up of inflation the last couple of years, but I think ultimately this will end in deflation, and then we'll start a new inflation cycle. So that's the start, and why I think this is all one big secular bull market. Within that, you've had cyclical bull market. So certainly, the 2008 was the bottom bear market and started in 2009, started a new cyclical bull. And before that, 2003 to 2008. And before that, we had several cyclical bulls within a secular bull. The reason I think we're topping out is because I think we are coming to the end of that long disinflation cycle. I thought it could have ended in the market that we had after the pandemic, and I called a melt up in March of 2020 when everybody was bearish, and called for 4,000 and expanded to 4,800 and beyond during that 2-year rally. In December of 2021, I said the market's needing a breather. It's going to correct. I didn't expect the bear market we got in 2022, but I did expect a 10-15% correction. And I looked at the bear market in 2022 and said, no, this thing's not done. You have not completed this thing. And surprisingly, melt-ups are very rare. People throw around the term melt-up, but melt-ups are what we saw in the Nifty 50. It was basically a melt-up in 73. What we saw in 2000 in the NASDAQ was a melt-up, but they are very rare. I've used the term melt-up. I'm kind of the author of it, not that it's a unique term, but in terms of these cycles now, I've been talking about it for the last 3, 4, 5 years. So all in, and because I'm on Twitter so much, I think a lot of what you're seeing in terms of the term melt up or the term bust are both coming from my calls. But people are using them in different ways. So the melt up that when people say melt up, lots of times they're talking about a 10% rally or a big rally. Melt up is a very unusual rally that goes vertical ultimately into the end. And I don't think we've gone to that parabolic part of the melt up yet. I think the melt up began back at 4,100 back in October. And so we're in the melt up, and I think it's going to steepen from here into a parabolic.
So that sounds like the Austrian school economics end of the currency when everything just explodes. But before we talk about perhaps what will happen in the future, I'm curious as to when interest rates hit zero and bond yields were yielding nothing and negative, why didn't you feel that was potentially the low, and then we get inflation from there, which seemed to be a very the Fed wrong-footed everybody by saying there's no inflation, then suddenly yanked up interest rates, which is another issue. But it seemed like we couldn't go any lower. It's the only way is up from here. It has been up. Why are we not already in an upward trend in interest rates and inflation?
So first of all, the reason why the cycle got extended is $5 trillion coming out of the Fed. I mean, that does a lot, and similar coming out of the government in terms of debt, and similar around the world. So that extended the cycle. I think the parabolic really didn't cleanse the system, but it really stretched the cycle. And so why inflation? Why not inflation now? I actually think the Fed is over tightening here, and that we're going to, and that's why I call for a global bust following this melt up. The problem is you have 320 trillion in debt around the world, and you have quadrillions in notional value of derivatives. The debt is obviously leverage on the system. The derivatives are leverage on the markets. And I just think we've got a Fed and central banks around the world that are managing policy, looking at backward indicators. And inflation has probably a 2-year lag, and they want to see the whites of the eyes of the 2% inflation before they're going to stop. That's a recipe for disaster. As I say, the Fed makes overstays are welcome on the easy side and the tight side all the time, every cycle. That's why we have booms and busts. But when you've got that kind of leverage in the system, we were not even there in 2008-9. We had leverage, plenty of leverage then. We are way beyond that leverage now. When you have that kind of leverage, or when the Fed makes a mistake or the central banks make a policy error, it's bad enough. When you have that kind of leverage and they make a policy mistake, you really, things go down fast and hard. So I think we're going to see, as I say, 2008-9, we came close to what I term a bust. I don't want to get ahead of ourselves, but if you remember when the commercial paper market froze up and GE was rumored to be going under, they couldn't fund their debt. And the government and the Fed acted pretty fast, unfroze that market, and we avoided the bust, because if they had moved any slower, we were probably going to see the bust that cycle. So the difference between 2008-9 and now is I think we go over that cliff this time. And there are a number of reasons for it, but the Fed's fighting the last war is one of them. So I think that we're, I'm in a very schizophrenic place in that I'm calling for the biggest rally in history, and then shortly thereafter, something that hasn't happened in the post-World War II era in terms of the downside. I mean, it just sounds crazy, and there's certainly lots of people that think I'm crazy with this call, but it's just where we are in history, I think.
I would say that doesn't sound crazy at all, because at the end of any major reversal, you get this parabolic move, and we've seen strong moves to the upside, but we haven't seen a parabolic move as yet, and therefore it makes perfect sense that you would have this phase, this kind of what I call the convincing phase, where everybody who's like out of the markets. I know you use sentiment indicators, or you look at sentiment. Obviously, what we have the expression here, it does what it says on the tin, and that's your Twitter handle is what it says on the tin, because you are a contrarian, and the markets are very, very bearish at these points, which it doesn't seem like it, but it is. Now, I look at certain technical indicators that show the percentage of people who are bullish against bearish, and 70% or more are bearish the market. So we haven't got to that point when everybody's suddenly flipping, going from 70% bullish to kind of 90%, sorry, 70% bearish to 90 to 95% bullish. You need that final phase, and that only happens when things just go crazy. It reminds me of the dot-com boom, when people were leaving their jobs as nightclub bouncers and teachers and doctors just to go into the market, and that's the end. And we haven't really got that as yet. It's not on the front page of the newspapers as to how these good times are rolling. It's still the opposite. What do you use for your sentiment indicators? Because you can obviously use the commitment of traders data, but do you use anything other than just kind of sentiment on Twitter and things like that? Or
yeah, certainly. I warn people against, particularly on my feed, looking at my feed and thinking that's sentiment, because I go, it's very biased towards my view on, obviously, for the followers on my feed, and so everybody's kind of playing this melt up, and they're nervous as heck. So some of it is feel, doing this for 50 years and through many cycles. Some of it is feel. I certainly looking at investors' intelligence numbers, or the commitment of traders, or the Bank of America portfolio manager survey. There's other sentiment indicators out there, but the one thing that's been, I think I've read pretty well, and I think people get it wrong. You just stated correctly what I don't think a lot of people understand, which is, in spite of being at 5,100. A huge percentage of money managers are still defensive, whether they're in cash, whether in defensive stocks, whether in bonds, they still have fought this thing. I turned bullish or I was bullish coming into it, but I was very bullish in October of 2022, and watched people fight that thing and say this is a bear market rally, and every couple hundred points saying this is the top and it's going to roll over and go to new lows. They did that all the way to probably 4,300, broke above 4,300. I said, yeah, maybe it can run to 4,600. And I did call that pullback to 4,100. But then you got down there and people are again back to, the sky's falling, this thing's going a lot lower, whether it's going to new lows or going back to the October 22 lows. What I saw consistently was it took very little rollover, just like yesterday, to have people coming out of the woodwork bearish. There's just, as I described, because once we got to 4,600 and above, on our way to 5,100, people are sounding like you now. Aren't you ready to turn bearish? You're contrarian. Everybody's bullish now. I go, watch. There's no conviction in that bullishness. I use the term, they're just caught up in the momentum of the tape. Sentiment follows the tape. And so they get more bullish as it goes up, but they have no conviction on that bullishness. And you see it. You get one day rollover and they get nervous that this thing's going a lot lower. So I think there's a huge wall of worry that will continue to fuel this rally.
Do you think the rise of, sorry to interrupt, do you think the rise of ETFs is partly responsible for these trends? Because a lot of investment managers aren't even human now, they're just algorithms.
Yeah, I think ETFs, algorithms, all of that, not to mention, so many retail investors are, whether it's through CNBC and Bloomberg or whether it's, all the things online, they really aren't investors. They come in as traders. I made the comment yesterday. It's, to somebody, I said, they may as well be, I think they look at stocks the same way they look at FanDuel. It's a very short-term mentality, and everything is driven by short-term technicals. So yeah, I certainly ETF. It's an easy thing to get in and out of, so people are more prone to that.
So the market got shaken up slightly. I mean, I say shaken up. We had a down day by the CPI number that came out yesterday. So we're recording this on the 14th of February, Valentine's Day. And yesterday, the CPI number came out at, what was it, 3.1 instead of 2.9, but it's going down. I mean, it's like the trend is down for the CPI. Yep. So showing that there's not much inflation in the system, and the market sort of threw a hissy fit. The dollar rallied, everything sort of, it seemed to be like a really big move. But actually, if you look behind it, it wasn't. And if you looked at the way the bond market reacted, which I think is the most important, it's not really, I mean, the dollar move was fairly big, but it's not that big. And the yield move wasn't significant. I don't think there's any conviction behind reversing yields going potentially back down again. And the curve for a interest rate cut this year is on. And that kind of supports the fact that the market should continue to go up. So I just wonder whether that was what you thought of that. Was that in terms of short-term analysis of what's just happened?
Yeah, I thought it was a bit of an overreaction, but it was clearly people were coming into that print, into that data release, thinking we're going to get good news on inflation and it's going to be off to the races. And they got the opposite. Not terrible, but just the opposite. And so with people all positioned for better and got worse, they just, they took that ball and ran with it. And I saw a lot of things basically that had gapped up the couple days before, just went back and filled in gaps. So, I think it was, but of course, what it did do is it caused people to then say, see, we're going to get, even for the people who aren't bearish, but are looking for a better entry point, we're going to get 5 or 6% correction here. The market's overdone. That's the other thing is I think people are so caught in the narrative that we have a magnificent 7 market and nothing else. And I go, look at industrials. They're at all-time highs. Look at home builders. They're at all-time highs. Look at a lot of groups have done well. And meanwhile, the Russell has lagged, but it looked like prior to yesterday, like it had. What people don't understand is you had a amazing November, December, a very strong market. Market moved 20% or whatever. And what you've seen in the last month or 6 weeks in a lot of groups, including the Russell, was a consolidation of that strength. Things have to consolidate after a big run, but they only gave back part of it, a normal part of it, and then the Russell, for instance, had turned back up and looked like it was ready to head to new highs, and then you got yesterday. But yesterday just kind of brought it back in and filled in the gap, I think. I totally disagree with the narrative that it's a Magnificent Seven market, and that it's a sign of a very poor quality market. I think you're going to see a lot of breadth here. Industrials, a lot of the materials groups, I think, are coming alive, or are ready, poised to come out of consolidations. So I think there's a lot of groups that will fill in here, and it doesn't mean that the Magnificent Seven or the large cap tech are going to stop going up. I just think they're going to be joined by others. So I've been big on semiconductors all the way through the last 2 years, and they've had a great run. I think they still have, SMH looks to me like it's still got 50% upside from here. So
wow, that is a call. So Tim, did you want to ask something here?
Yeah, I was just going to ask David, how does that relate to, I mean, something that's very dear to my heart and our clients' heart is gold and silver miners, which we've owned for quite some time, but which have been languishing for the last couple of years. Do you see those turning around anytime soon?
Yeah, let's put it this way. Yesterday I took it on the chin some more, but I've been a bull on the miners and the metals, and I still think gold's going to break out here shortly and go to 3,000 pre-bust. And that's what I use as my timing. It's not, I don't know what month or even what quarter, but pre-bust, I have a target of 3,000 on gold and a target of 60 on silver in that same time frame. And I've said that it might even move through 60 to 75. That seems ridiculous right now with silver at 22. And certainly the miners have been beat up very badly these last couple of years. So I hear from a lot of people saying, yeah, your melt up call is amazing, but boy, you've done a terrible job on the metals and miners, or particularly the miners. I think you're bottoming. I mean, I think this thing is very near a big turn. I keep saying it's dependent on the dollar rolling over. I have a dollar call the DXY going to 80, and that's what it's going to take for my targets, I think. So it's just sometimes markets take their time. In this case, we had a very strong dollar, and a couple of years ago came down sharply, and we've had a couple of counter trend rallies here just because too many people became believers in the downside, I think. But I do still think the dollar's rolling over, I think, as we speak, and should head for probably next stop mid 90s and then 90, and then once it breaks 90, I think you'll see 80 fairly quickly.
You mentioned, I hear what you say about market breadth and that you expect things to broaden out, but I think I'm right in saying that the market cap of Microsoft and Apple combined is 70 times the value of all mining companies certainly in the US, if not the world. It's like a staggering proportion. I don't know what that ratio should be. It probably shouldn't be 70.
No, yeah, I think, again, what I say to people is my melt up call to S&P 7,000, NASDAQ 23,000, Russell 3,300, Dow 55,000 does not mean I'm endorsing that as a good value. I'm not saying it deserves to be there. It's just we still have a lot of money sloshing around from the pandemic, and we had everybody get to one side of the boat. Back a year and a half ago, and so a lot of those people, I think, are going to, in a concentrated period of time, come into this market and create that parabolic run, and you get sort of a buying stampede, where you get a big price move, not necessarily rational, although people will rationalize the move. and say this is why I think it can still go, just like Nvidia now, or Microsoft, as you say. But on the other side of the mountain, I'm calling for an 80% bear market. So it's not that this is deserved or is fundamental. I just think it's where we're going.
On the silver call, I think that's a really interesting one because if for anyone who doubts that as a possibility, they should go back and have a look at what happened in 2010 when silver was trading around $18 and then took off towards within a year it was trading at $50. So that is the sort of thing that this compression from a technical point of view looks like we're building up to, because gold has been flirting with new highs, trying to break new highs, and it just feels like it really wants to go. Silver's just, it feels like it's also just being held back by something, and
Yes.
when everything starts going, it's just going to take off. And I to be honest, before Christmas I was like saying, yeah, this is it, feels like it's going to go, really nice little technical pattern, and it went up and it just came back into that range again. So I've seen that happen a few times where it tries to break out, doesn't, and then when it goes, it's like no one can jump on it because it's going so fast that it just does not give you that chance to come back. And
yeah, it's one of those, people don't realize the mining industry. If money managers ever decide, we need that 5% in miners, I mean, this is such a very small cap group now. I mean, there's very little capitalization of miners out there. It'll blow the top off. So it's very hard when you're at, and I keep saying this to people, I go, I got the same treatment, back in October 2022 or the summer of 2022 when I was, talking about the equity market, because they keep going, well, your equity market call was a lot. It wasn't this difficult. I go, it was. You don't realize how beat up I got for being bullish when everybody was bearish. And I go, that's, you're seeing it here. I have guys saying to me, gold hasn't done anything in 40 years. I go, do you realize gold went from 250 to 1900 in the first decade of this century? Do you have any idea that silver went from, a buck to 48 or a couple bucks to 48? I mean, it's just, they have no memory of it because it's been such a difficult trade for a number of years. We had a strong 2016. We had an amazing couple months coming out of the lows in the pandemic. What we saw in April, May, June, July of 2020 were big moves. Other than that, it's been, it's just killed people. So I think you have sentiment at rock bottom, and nobody expects anything, and they can't come up with a bullish story. And I keep saying, I'm bullish on bond, I'm bullish on the, and I'm bearish on the dollar, I'm bearish on interest rates. You get interest rates down sharply, and you get the dollar down sharply, and that's a recipe for the metals.
I had the feeling that maybe something had to come into the system to make the Fed cut interest rates to make the dollar go down. And I'm kind of putting the cart in some ways before the horse, because I look at things technically and it looks like this is what's coming. And I'm trying to think of what could possibly be out there that would make this happen, if that makes sense. And I just wondered whether you feel that there could be something, like, for example, in the UK, we have a retail chain called the Body Shop, and it's gone.
We used to have a retail chain called the Body Shop.
Used to have one. Yeah. They're just trying to save it, and so that's, I mean, that's obviously not good news. So there are things that are bubbling off in the background that is bad news, and I'm sure the markets will shrug it off because that's how it's looking like it. The underlying macro themes, but there are problems, and a bank is going to take a big hit on that. There would be some lending and all that sort of stuff. So I'm just wondering, do you think there's a possibility that we will have another shoe to drop in terms of the banking sector, perhaps in America or maybe elsewhere, that would then get the Fed to go, whoa, hang on, let's forget about this, this 2% target. Let's just get interest rates as low as we can as quickly as possible.
Yeah, I definitely think that's coming in the bust. I don't know whether, I don't know what we're going to, I keep telling people, my bullish call on the equities does not depend on the Fed cutting rates. That I think they may cut rates this spring, but it's not dependent on that, because I go, the bond market is, bond market moves before the Fed. The bond market is, I'm pretty confident in calling lower rates. I think you'll see a 2.5% 10-year at the peak in the equity market. So during this melt up, I think you could move to 2.5. During the bust, I think the 10-year can move to 0 or negative rates. During the bust, I think short rates will go negative. So I'm the rare guy out there today that doesn't think we've seen the low in the secular move in rates. I think we have one more lower low. And it's because the economy is going to be so, but the financial system and the economy is going to be so bad. But getting back to what could happen.
That's post bust. Sorry to cut in, but it's really important. So in terms of timing, that is post bust, not this year.
The move to 2.5 is in the next 6 months, 3 to 6 months. The move from there, then you might get a backup in rates for a little while after you have that move. And then the move down to 0 or below on the 10-year, and probably 1/4 to 1/2 on the 30-year, and definitely negative rates on the short rates. That happens in the bust as the central banks are having to react to a financial system in free fall. And that's what I call a bust. A bust, unlike 2008, I think this time they're going to be slow to react. They're going to, they've already told us they don't want to do what they did in 2008 again, or in 2020 again. They're not going to do QE like that again. I guarantee you, when they're faced with things free falling, they're not going to be worrying about inflation at that point, or what a Fed put looks like or whatever. They're gonna be saying, we got to save the system, and there's only one tool at that point that they can do quickly, and that's money. I think you'll see, not to jump ahead, but I think you'll see 20 trillion come out of the Fed. So we did 5 trillion in 2020, 21. I think we'll see 4 times that, and in terms of monetary expansion. And
that would be consistent with the dollar completely, let's say, coming under the cosh.
Yeah, it's funny because I'm getting away from the original question, so I know I do this, but I think you're going to have a move this year, and the first 3 quarters this year, in the dollar down to 80. That's before all this money is created. When the money's created, ironically, I think the dollar is going to be the flight to safety during the bust. So you can go back to 120 or above as a final hurrah on the dollar. And I think later in the decade, the dollar could be below 50. But so the dollar may be going up while they're printing money, because every central bank's going to be doing the same thing. And I think people are going to run to the dollar as they always do in crisis. So the move down to 80 is not dependent on flooding the system with money. It's really, I think you're right. I mean, currencies are technically driven. I think technically it looks like it's going there. What could move it there? I do think, going back to your original thought, I do think there's a decent chance, and I have to caution, because people get mixed up between a scenario and a forecast. My forecast is clear. There is a scenario I can draw where the Fed does start easing this spring, before May or June, and maybe even March, but certainly sometime this spring, because the economy is weaker, because we're caught in this game of, they got all excited about the labor numbers last Friday.
Yeah.
Most of the gains were part-time jobs. Our full-time jobs continue to decline. The economy is not in good shape. We see it in delinquencies. We see it in, there's a have and have not economy. So the haves are spending like crazy still. Their investments are all up. Their homes are at full value, and they've got jobs, so they're spending. But there's another half of the population that's barely getting by, and they're having to use their credit cards to buy groceries because groceries have gotten so expensive they can't keep it in their budget. Those are all bad signs that we're coming to an end. And yet the Fed is focused on a lagging indicator, labor, and another lagging indicator, inflation, fighting the inflation, which by the time they conquer inflation, you're 2 years too late in terms of easing, or a year too late at least. And labor's going to roll over later. If you should not be using that to determine policy. So I think what they're doing is all wrong. I defend Powell. It's funny because I've been a big critic of his over the years, but I defend him in this way. I go, I thought we'd see recession before now. I thought he was overly tight sooner than this. Up till now, you can't fault him. He's been right in terms of, if you look at measure him by what we're looking at right now. My problem is, by the time they realize they're wrong, it's way too late. So I do think he's making an error, but you're not going to know it yet, or you don't know it yet.
You've alluded to food and to the economy. To what extent, if any, does politics form an input into your process?
Yeah, in this particular cycle, I don't think a lot. Here's where I do defend Powell. I do not think the Fed is overly political. I mean, they have to be a little bit. I'm sure they're getting some pressure from Brainerd and Yellen and Biden spokespeople in terms of saying you got to help us here. But I think generally Powell and his fellow governors are really focused on the economy and the system, and are trying not to get in the way of the election. At some point, as we get closer to November, meaning late summer, they may just feel we can't do anything, and that could be a problem. But without appearing political. But at this point, I don't think politics is really what's going on here. I think Powell is, paying attention to something he shouldn't, and that is the stock market. I've said over and over, he bought hook, line, and sinker into Dudley's view that the stock market's a big part of financial conditions, and it needs to, I think he alluded to, it needs to get down under 3,000 on the S&P. And I think for the next year after that speech in April of 2022, you could see Powell, every time the market lifted its head, out came his cronies, out came his fellow governors, jawboning the market. And he kept trying to do it, and the market kept going higher. So finally, earlier last year, he gave up, and at least wasn't as obvious about it. He still made his efforts in his, post-Fed meeting speeches. He would, commentary, you could tell he was still trying to keep the market at bay. It didn't want it to run away. And I think that was some of what, happened last week, is, his rhetoric was, I just don't think he likes the market up here. And it's because he bought into Dudley. I think it's so wrong. As I've said, Fed governors should not be focused on the stock market. They are the last people I'd expect to know where the market should be, and they should not be deciding where it should be. And obviously, they can't control the market anyway. So, but I do think that is something that could play a role here. If we get my forecast and we go to S&P 7,000, on the way to 7,000, somewhere above 6,000. I believe, let's say the Fed has done a cut, or not, but let's say it might have cut, this spring. If by, let's say, middle of the year, we're above 6,000, they may take that cut back and hike some more, just on the basis that they really think they have to control the stock market. They may look and say, there's just too many animal spirits out there. Risks are getting away from us. And that's going to lead to inflation getting heated up again. and that could be the final policy error that kind of breaks the camel's back in terms of hiking on the eve of an economy that's very fragile and could roll over pretty quickly.
I suppose the reason I asked the question about politics is really for geopolitics. That from the perspective of a Brit watching what's happening in America, you have a serving president that seems to be visibly suffering from dementia.
Yes.
The optics look dreadful. You have a proxy war in Ukraine. You have basically what looks like war in the Middle East, like possibility of war in Asia and South Asia, maybe Taiwan. And the Biden administration doesn't exactly seem to be unhappy about funding all of this kind of stuff. So I guess that touches back on the dollar again, which is if you have an administration that's already 34 trillion in the hole, and it's just writing checks left, right, and center to pay for foreign wars and foreign adventuring, something's got to break sooner or later.
And by the way, not only that, but we're spending so much additional money on the invasion into this country. I mean, tens of millions of people coming in and being put on the dole. We're nobody's talking about MMT, but they're certainly practicing it, right?
Sure.
They seem to think that money grows on trees and you can do this forever. My scenario beyond the melt up and beyond the bust is one of saying that the Ponzi scheme comes to an end. The scheme that's been in place since the Great Depression, so 80 years plus, will come to an end, I think, early next decade.
So will we have a new currency then? Could there be a whole new regime? Because I'm guessing you're not a fan of cryptocurrencies, but what if they try to bring in a CBDC in order to get everybody back into a new system and let the old system crash, sort of thing? My view is that's the only way they're ever going to do it, if they're going to do it, because people would not naturally want to take on a CBDC.
Here's and this is probably a good time to respond to what you mentioned before about the Austrians. I am not at all in the Austrian camp, and only from the standpoint probably of timing. The Austrians tend to think, as you said before, that this is the peak and then we crash. That the beginning and the end begins right after that. I believe there's one more cycle because this bust is going to be a deflationary bust, temporary, short-term deflation, but for maybe a year you might have deflation.
And no heavily indebted government can afford deflation.
And so in the face of a free-falling financial system and deflation, you're going to get, as I said, 20 trillion coming out of our Fed and proportionally similar out of the ECB and the Bank of England and Bank of Canada and Australia and probably even People's Bank of China. So you're gonna see money like we've never seen, and it gives you one last cycle. I think the peak this year in the stock market is a peak we won't revisit for decades. However, I think we do, and I think we will have a cyclical recovery following the bust, and the bust probably doesn't last much more than 12 months, maybe 18 at the most. Bear market probably lasts 8 to 10 months. So this is going to be quick. It's going to be steep and quick. And then I think by the second half of this decade, you've got a huge commodity cycle / industrially driven cycle that can take oil to $500 a barrel, can take gold to 20,000, can take silver to 500, can take all the commodities, including agricultural commodities, through the roof. You'll see 25% inflation by the end of the decade. When you put all that together, and at the same time, the 20 trillion, I'll just talk about the US, but the 20 trillion here will probably be matched in terms of, debt coming out of Treasury. So you've ramped up and you're doing this all over the world. That 320 in global debt probably becomes something like 450 to 500 trillion by the early next decade. You can't, I know in the US, we have trouble funding or servicing our debt at 5%. imagine if the long bonds at, 16, 17, 18% and treasury bills are at 23, there's no way long before that we're not going to be able to service that debt. So we're out of the capital markets. The central banks are out of the printing press game, because it'd be like having a fire hose with gasoline coming out of it in a California forest fire. You can't, at a certain point, that inflation just going to keep going higher almost immediately if you're pumping more money. So they'll be shut out of the game. So in my opinion, it's the 2030s. You basically see the collapse of the world system. I don't know exactly how the Chinese or the communists come out of this, but I don't think they're in any better shape. So I think it's basically worldwide collapse. I've made the statement that, and again, it's totally guesswork and seat of the pants, but there's, again, this is scenario, not forecast, but I could see a scenario where there's 50% plus unemployment in this country, no Social Security or Medicare, or very little, no unemployment benefits, no welfare system to speak of. The government's bankrupt. It's a dire forecast. So getting back to CBDC, it's the question is, does this all happen so fast that their hands are full and they got too many other things to worry about, that they never get to that? I worry terribly about digital, central bank digital currency. I don't think it's coming in the next couple of years, and I think by the end of the decade, I'm not sure whether that's going to be a priority when they've got so much else going on.
So wouldn't gold be an asset that people would want if they were in a position where the financial system is imploding and they can't rely on the banks? I mean, if you're in a position of 50% unemployment, you're gonna need cash. But I don't know how the banking system would look in that environment. That could only be a full-scale collapse of the banks, and the banks not trusting each other. The system just wouldn't work. So you'd have to be outside the system. The only things that are outside the system potentially would be cryptocurrencies or gold and silver. Do you think they have any place at that point in that Armageddon?
I'm sure in small pockets. I just don't see where, if you've got a systemic collapse of the worldwide system, maybe things will come along, but I don't see where Bitcoin or crypto can take up that slack in any kind of magnitude, right? It may do very well for those that are there, but I don't see how you can do the magnitudes to offset what I think is going to be a total systemic collapse. From a central bank or government controlled digital, I just don't, I don't know how again, the banking system's collapsing. I'm not sure how the digital currency will make anything much better. The control isn't going to be their biggest worry at that point, or if it is, it's going to be a totalitarian control that doesn't require digital currency. And gold, I think gold certainly is a huge investment post bust into this collapse. I just think everything collapses. Pretty much everything collapses in there. What comes out the other side, it's going to be probably several years of pain, and then what comes out the other side is anybody's guess. Could be, my fear would be it'd be totalitarian, of some sort. But I am where I don't think there's I kind of think the Austrians think that you can kind of have let's get the collapse over with so we can start fresh and clean and do this right. I just don't see that as a likelihood, as a scenario that we run into.
During the Greek financial crisis, I remember Yanis Varoufakis, I believe is his name, the then finance minister, was in discussions of leaving the European Union, and they were thinking of using something on the basis of the equivalent of their national insurance numbers. I'm not sure what you call it in America, but they were going to create a system where they were going to effectively start a new banking system or new currency based upon that. And they would do it. They were in the process of doing it. And then I think the then president, who was actually a friend of his, sort of said he was going to do it, and then sort of went all political and for some reason didn't. The reason why I mention it is because it seems in a crisis a lot can be done quickly because everybody's motivated to getting the problem solved. But the other reason for mentioning it was that Europe is always in the back of my mind as not being very stable because of the euro. And anyone who understands markets, they compare Europe to the US in the States, and they say, well, you can have a single currency in America and separate states, and why can't we have that in Europe, and et cetera, et cetera. Now, that's all well and good when the economy's doing well. The problem comes when the economies are pulling apart, which inevitably they do, because not everybody has German discipline when it comes to monetary policy. And, the Greek and the Italian and the Portuguese currencies were always declining just because of that reason, and balancing their economies by doing it meant things were cheaper, so money would flow. So it seems to be that this understanding or not understanding of how markets work led to the European project that's always on the brink. It's got to the brink, and then it's sort of come back again, and it's got to the brink again. And now we've had Brexit, which is one step, but we never were going to be in the currency anyway. And a lot of countries who were going to take up the euro but still be in Europe didn't do it because they kind of saw the light that it was a bad idea. You got the Czech Republic that hasn't got the euro. You got Slovakia that has got the euro. I know they're just small economies, but it just goes to show Poland was definitely going to take it and then decided against it and went very anti-euro. And there's more anti-euro sentiment behind that. Do you think in this kind of collapse scenario, it's never the same, is it? Things are always different as to what triggers the collapse. In 2008, it was obviously the lending, the prime lending that was just off the charts, and ninja loans and all that sort of stuff that had been when we had financial instruments multiplying that, and everybody knows very, very well what happened there. But this time it may be something like a country leaving the euro and then causing an upset just at the wrong time that then collapses the system. Do you have any view on where it might come from? And I know that's a difficult question.
Yeah, I'll separate out the 30s is, still, I tell people don't stay up worrying about that one because that's, we have a lot to get through before we get there. But talking about the bust, which is in the next year, I think, I think there is a risk that the ECB or the euro doesn't make it through.
Wow.
It seems crazy to say that so near term, and it probably does. Somehow they figure out how to patch it and keep it. But you're right. I mean, Italy and Spain, for example, trying to keep those countries together when they don't have the ability to kind of float a currency and devalue the currency and figure out a way to get through things. When they're held to these strict measures, and their economies are suffering. So, yeah, I think that's tough. Germany's even obviously, your strong ones, Germany and France, are now not so strong. So I just think it's not an easy thing to hold that together, and it may not. I have said that, in 2008-9, obviously it was the U.S. banks that led the whole worldwide situation. I said this time it's more likely to be led by the European banks. That our banks were forced to get religion, so not that they're immune to the problems, but they're in better shape than most of the banks around the world today. The major banks, the big banks. So it's more likely Australia or Canada or Europe or even Asia is where the problems could be triggered. There's enough counterparty risk that I don't mean to say the U.S. is immune from it. They're going to suffer. And certainly our regional banks with all the commercial real estate exposure could be a problem. But yeah, people think the global bust has to be triggered here. I think it could easily be Europe. I mean, you guys have been through, it's amazing to see what went on after the pandemic and then the invasion of Ukraine, and what went on with energy prices, and the loss of the Russian energy, and to think you're still kind of muddling through is, to me, underneath the surface, things are not good.
So your view on energy in the short term, with all commodities going higher, am I right in saying that you think energy or oil is going to go down? And if it does, that would be a really interesting boost, an extra boost to the economy, wouldn't it?
Yeah, I've been, I was caught, like I guess others, with the Russian invasion, and it spiked to 130. I've been bearish since 130. Caught a lot of flack while it was bouncing around there up around 120. But I had said we'd go back to 85, and then when we got there, I said we can go to 60 or mid 60s, and I'm still saying that's kind of the next target, is likely down to low 60s. And in the bust, I think oil can go to 30. So doesn't mean it can't bounce up back up into the 80s before it goes to 60. I don't know what's going to do in the very short run, but it is kind of, people have struggled because they go, all your other call says dollar down, commodities up, and yet oil, you're saying oil down. And I go, yeah, it could tread water for a little while. I just think the supply demand situation out there in the world is there's a lot more supply than I think most of the street understood for a while, and so they missed it. Everybody was looking for $100 oil again, and certainly portfolio managers were all, up until probably the last 6 months, maybe it was 9 months, but energy stocks were at the top of their lists of most attractive groups. And I said, no, I just don't think so. And I don't know whether long-term charts work, but if you put a 20 or 25-year chart up on, XLE, it's a huge head and shoulder that you just rolled out of the right shoulder within the last year, and counts down to 20. I think, I don't know where it is now, 80 or whatever, or 85, but I think energy will get hit hard in the bear market. And then, coming out the other side, I'm very bullish on oil, but I just think for the next year, it's not looking too good.
So in terms of your analysis, you mentioned reading the tape, which for me is a giveaway that you're a price reader. Like, so you read price action and don't use things like oscillators and all that sort of stuff. Do you use any other, like Elliott Wave or GAN or anything like that, or are you just a pure chartist? Which is,
yeah, I would say I'm really a back of the napkin chartist. I'm not by any means a professional chartist, but I don't do point and figure out and do any of that. But yeah, I look at charts for sure. As I say, my calls, my analysis is fundamental and technicals, macro, cross markets. I think cross markets can tell you a lot, and then sentiment. And putting all that together, if I can get all of those to agree on a conclusion, then my convictions go up. If it's only a couple of them, I don't have the convictions I have when everything's kind of telling me the same story. But I do. I'm being a contrarian. I'm kind of opposite of the trend follower. So like down here, trend followers will tell you forget about the metals, forget about the miners. And yet this is when I'm attracted to the most, is when they're down on their bottoms. And at the top, when momentum's strong, I'm going to be turning bearish on the market. So contrarian at both extremes, both bullish and both at tops and bottoms. I tend to disagree with the chartists, but I'm looking at the charts help me in terms of perspective, in terms of longer charts.
Yeah, I mean, it does depend. I mean, it depends how people are looking at charts, because I totally agree with the idea that you look at what's running, what's in trends, but you also, part of technical analysis isn't just looking at trends once they formed, it's looking at
Right.
the trends that are about to form, and
Yep.
you don't take your eyes off those, because those are the ones that are up 20% before you've kind of noticed, and then it feels very hard to get in. So yeah, you're right.
It's funny, it kind of coincides with people, because I'm a contrarian, they think I'm always contrary, and they go, you're getting a lot of people agreeing with you, aren't you uncomfortable? I go, you have to understand, I'm very comfortable being the only bull at the bottom or the only bear at the top. And I said, that's almost what it's like at the very turning point, is almost everybody disagrees with me. And I said, for whatever reason, I'm comfortable being outside the crowd. But in that middle part, the consensus is often right. And I said, I'm going to be as consensus as anybody else in that middle part. And it's same thing with kind of relative strength, like you said, that, there's in the meat of the run, relative strength works great, but you just have to be careful at the turning points.
Yeah, absolutely. And it's how you measure it, which was what I was asking at the top, about what you use for sentiment, because what I also noticed that in the .com crash, there's far more people actually talking about a potential crash than you might think. The word crash gets used a lot. And I was quite surprised by that, because I was almost thrown slightly from it, because I was seeing all these signs that the market was going to crash. There were people telling me how that they knew this guru who knew all the tech stocks to get into, and how brilliantly they were doing, and there was this gung-ho air about it. And as I say, people leaving their jobs and in order to trade, and we know it's a professional, very difficult thing to do. You can't just leave a job and suddenly start making money, because it's not going to work like that. You have to pay your dues and do your analysis.
People were getting second mortgages and putting their money into .com stocks they knew nothing about.
It's possible if you're Nancy Pelosi, though.
Exactly.
But so those, but then at that time also, surprisingly, there were a few people saying, oh, in the main media, which threw me slightly, as I was saying, they were talking about a potential crash. And I was thinking, markets don't crash when people are talking about a crash, but actually it gets to that point where it's almost like a completely crazed party, where nobody's listening to the fact that the place is on fire and they need to get out. But there are a few voices just going, oh, hang on a minute, this doesn't look right. Let's get out of here. And so
there are always some people that have discipline and say, this is insane. I can't possibly make sense of this, and I think this is going to end very badly. But it's that majority that, and I say this to people now who talk about selling. When we see what you're calling for, I'm getting out, and I go, you have to understand, at the top, it's going to be a very compelling story that's going to make it hard to sell. Everybody thinks it's going to be an easy sell. When we get there, I'm getting out. And I go, that's not how it works.
Yeah. Markets fall out of a blue sky. In Media Picks, I think we're going to find a book that you recommend in terms of the financial markets, but I can just sort of feel that there'll be people who want to learn how you've kind of married these principles together, and whether there's any way that you actually either teach it or what steps they might need to do in order to replicate your method of analysis.
Yeah, what I tell people is it's the 5 things I listed before is how I approach it. But I'm on Twitter every day, and I'm basically retired, so I'm on Twitter every day with the idea of retail public in particularly is exposed to all this stuff out there. Most of it, turns out to be 180 degrees wrong, because the consensus, can be wrong. They get caught in all the narratives and all of that. And I just said, I can, when I started doing this several years ago, I just want to be a voice that kind of counters that. It doesn't mean I'm always right, or it doesn't mean I have all the answers, but at least you're getting an alternative view that can make you think and consider another narrative. So that's what and through over the years, it used to be I initiated tweets more, but in the last few years, most of it's replies, and I might have 50 or 100 replies a day like yesterday. And I think if people pay attention to those replies, the reply is to somebody, but the replies are really meant to educate. There's not every reply, but there's a lot of things in there that if you accumulate that view can help you kind of understand markets better. And certainly a lot of it comes from a contrarian perspective and from the standpoint that, listen to the market, but don't get, caught up in momentum, that kind of thing. But that's sort of how I teach. I don't think if somebody said, sit down and tell me how I get this. I mean, people will direct message me and say, will you mentor me? I don't know. I'm sorry. I've got grandkids. I've got other things I do in my life. I'm busy enough doing what I do on Twitter. But if you pay attention to that, I think it's a form of mentoring the masses in terms of what I do. So, it's not everybody's cup of tea. Some people really don't like that I am not, a trend follower or what have you. But it's a different voice.
But obviously you can't really care what other people think, right? Because that's not it's well known that the most sort of popular research is often the research that's wrong. And by dint of the way the markets work, as soon as people are agreeing with you too much, there's a problem. So I worry when people agree with me. That was always my thing. And so the 2007, well, I call it 2007 crisis, but I was working in a bank and saying what I could see from both the technical and kind of logical point of view as to what was going on. And you just see how people who've been educated in classic economics get it wrong, because the Bank of England, they were worried about inflation, so they wanted to keep, oil was going up and they wanted to move interest rates up higher, and you just see the banking system's imploding, and nobody's looking at, and everyone who's using economics is just looking at the unemployment numbers and saying, oh, they're fine. It's like, just absolutely crazy. It's absolutely crazy. But nobody really wanted to listen that things weren't as good as they thought they were. And that was a real contrary call, because I could find virtually nobody who agreed. And the mistake I made after that was I stayed very bearish. To be honest, I think it was a feeling that the markets hadn't really dealt with the problem that they'd seen, and inherently I felt like that was wrong and there needed to be some form of correction. But in terms of technicals, the technicals were like pointing to the market going higher. It was one of the few times when I was like ignoring my core method of analysis and thinking this can't continue, which is that is a lesson as well, that sometimes you kind of your instincts seem to override what you feel should happen. And
I think when you go back to 2009 and look at where we were, you felt there was another shoe to drop, right? It just didn't seem like we had, and even for people like you or I who know the markets discount things ahead and move ahead, it just didn't seem like it was, we had dealt with the problems in the way we needed to yet. But
1987, I could have understood more, because that was concentrated on a lot of speculation. It hadn't permeated the whole market. Whereas 2008, it felt like there was so many people who were caught up in it, and obviously all the banks were caught up in it. Every bank, one way or another, was caught up in it, whether they liked it or not. It just felt like they've just papered over the cracks here. They haven't dealt with this problem at all. They're kicking the can down the road, to use the expression that's been used ever since then. And at some point, it's got to come home to roost. And perhaps we are actually within shouting distance of that situation now, it's a very interesting timing that you've come on to talk about that potential that's coming up now. But David, all I would say is that it's been absolutely fantastic having you on the show, and I would very much like you to come back on. But before we sort of wrap things up, was there anything that we didn't mention that you'd like to mention to our listeners?
I guess just probably, we did talk about interest rates, but just understand there's going to be a period here where I think the stocks, bonds, and the metals markets are all going to be moving up together. And we don't get that often. Everybody's trying to figure out which of the market's going to move. And I think we're almost in that sweet spot pretty soon here where you're going to get all three of those moving up together. And that's okay.
Right. Brilliant. Tim, any final comments before we go to media picks? And
nothing to add.
Okay, great. What is your media pick for us then, Tim?
I think I'm going to struggle to match whatever David is going to pull out of the fire, but I'm going to give it a go. It's not so much a media pick as a person. I don't know if I've mentioned the guy Ekhart Tolle before.
Yes.
But I got into him probably a year or so ago with a book called The Power of Now, which I guess I suppose my thesis is that we're engaged at some level in some kind of spiritual war in terms of what's going on in the economy and in geopolitics. And for people who, I mean, I think David's also given us plenty of reasons to be concerned about the future. The future, of course, never technically exists. So this is the beauty of the Ekhart Tolle book, The Power of Now, which is he advocates living in the now and appreciating the now for what it is, which is, I appreciate it's going to sound a little bit strange for a sort of financial related podcast, but I suppose what I'm looking for, and I think what a lot of people are looking for, is some kind of comfort, some kind of inner peace at a time of extreme change and extreme discomfort. And so there's an audiobook that I came across on Spotify that I've started listening to, and it's by Ekhart Tolle, and it's called Stillness and Rising Above Thought, which is it's very, 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 I suppose, gives you a lot of spiritual solace. And if I could just put one idea of Eckhart's, who sort of distills lots of wisdoms from a lot of different religions, Christianity, Judaism, Buddhism, Hinduism, and so on. I think the one thing that I'm starting to appreciate is that one of the biggest problems with humanity is that we have this, what Eckhart would call this egoic identity, which is basically the self. And the egoic identity is intimately tied up with the brain, which is constantly sending us thoughts, most of which are distractions and dangerous and not required. So if you can find some form of inner peace and effectively suppress the egoic identity, you will be a lot happier as a person, which I appreciate is a slightly strange thing to be coming out with, but I found it enormously valuable to discover this gentleman Ekhart Tolle, and I'd recommend him to anybody.
I totally agree. I was listening to his audiobook of The Power of Now, and it was fascinating. It really was. And I think it's for anyone who's involved in the financial markets, recognizes the kind of stresses that are involved, pulling you in different directions, and the mental game that it is, obviously having interactions with people who disagree with you, having your calls and having the market kind of either agree or disagree with you. It is stressful, and life is stressful on top of that. This is why trading is so difficult and investing. But anything that can help with your personal wellness is very valuable, especially, I would say. So I'd say it's a very good thing to be looking at, and one that's often overlooked when it comes to the holistic element of investing and trading. Yeah, no, that's brilliant, and thank you. David, what did you have for us?
Yeah, mine's a bit more mundane, I guess, but I have suggested this many times on Twitter. Back in 1977, I read a book when I was, my first few years in the business. I was already a contrarian, but I read a book. It was at that time, I think it was called The Psychology of the Stock Market, and it has had many new edits or new editions since then. And I think the latest one might have been in 1998. So it's an old book called, and the title changed. So it's Contrarian Investment Strategies. I think it's pretty much the same content. It was written by a fellow by the name of David Dreman, who was a long time columnist for Forbes magazine, had his own money management firm in New York, or actually Jersey City, and was a Canadian, but very much a contrarian. And I remember reading, and I haven't read it since, but I remember reading it in 1977 and saying, it just, it was easy to read for me because it was speaking my language, but it was also laid out in such an easy format, an easy way to understand the concept that psychology drives the market, or is a very big component of the market. And so I think for any retail investor, and frankly, I think some professionals could probably benefit from it too, to just understand the power of psychology in the markets. And again, it's a kind of an oldie but a goodie, but I think one that should be must reading for anybody new to investing, at least.
Did you say he was an anchor? Because I think I've read it actually, but it was a very long time ago when I read it, so I can't remember whether it's the same book.
Did I say what was he?
Was the author? Was he an anchor? Was he like a financial anchor on one of the main?
He was for Forbes magazine he was a columnist.
Oh right, okay. So
you probably might have seen him in there, and he probably wrote for other publications at times, and may have appeared on, certainly could have appeared on Wall Street Week or any of those back then.
Right.
But definitely a contrarian at heart, and, lived it in his money management firm as well.
Right. Brilliant. Well, mine's just going to be pure sort of entertainment. So I'm going to choose something I saw on Netflix, which was recommended to me, and I've never seen anything like this before, is all I can say. It's a 3-part documentary, but each part is only 45 minutes, so you could burn through it in an evening. And once I started watching it, I couldn't stop watching it. It's called An American Nightmare, and it's about the kidnapping. This lady was kidnapped, and it's the story behind what happened. Her partner gave a story to the police. He didn't actually report it for a few hours afterwards, which they found very suspicious. And what happens afterwards is just, you couldn't make it up. You just really couldn't. Fact is greater than fiction in that regard. So it's pure entertainment, but just incredible. And actually speaks, I know, relate everything back to markets one way or the other, but it just seemed to fit in with how, whatever you look at, you've got to also, question what you're seeing, because it's never as straightforward. And I think that's a good lesson to come out from that documentary. But I'm sure, people will enjoy it, because so far everyone who's watched it has just messaged me afterwards going, oh my God. David, thank you so much for being so generous with your time. And just before we wrap this up, what is your Twitter handle for people who are listening? And I couldn't find a website for you or something that people can sign up to, but I believe people can do that by messaging you.
Yeah, I am on Twitter most days. So my handle on Twitter is @Dave H Contrarian. So not David, Dave H Contrarian. And I caution people, as we all know, Twitter is full of these fake accounts. So people will change a letter in Contrarian or what have you, and use my profile to make it look like me. And I just tell people, I've got 196,000 followers. Most of these fake accounts don't have 1,000 followers. So look at that first. I don't have more than one account. There's only that one account. So, just beware, because it's easy to get fooled. I had somebody this week say, did you recommend something? I said, I don't recommend anything as a strategist. I just forecast. So I get pulled in. So that's where they can find me. I do write a quarterly investment letter, macro-based letter that's by subscription. And I tell people they can direct message me on Twitter, just DM me there, and I will respond with details about cost and, what's involved, what is included in that letter.
Great. Absolutely fantastic. We'll put a link in the show notes. It would obviously be the correct handle, but as you've said, just watch out for people doing these fake. Anyone who's got lots of followers, they seem to proliferate these fake accounts. So just be very, very careful. David, once again, just thank you so much for coming on, and hopefully you could come back on again in a little while.
Lead us through the wreckage.
Yes, exactly.
Yeah, that's right. You can maybe 6 months from now we can look back and say, either you got a lot of that right, or gee, what were you thinking?
Well, exactly. It's no one's got everything right 100%, and I think people need to understand that as well. The market is a fluid environment, and things change, and you can only give your best view at that time.
Well, as I say, you're forecasting the future. You're going to get some things right, but you're certainly going to get lots of things wrong too. So.
Absolutely. But once again, thank you so much for coming on the show, and we look forward to having you back.
It's been my pleasure. Thanks, Paul. Thanks, Tim.
Thanks, David.
We had an online question about David Hunter's history in the markets, and because he was kind enough to give us a very comprehensive answer, I decided to put it at the end of the podcast in order for the people who are interested to jump to. So here it is. From when you started in the markets, have you worked in any sort of major banks or institutions, or have you been mentored by anyone who we may know as names in the markets, or have you just learned everything yourself?
Yeah, it's I started. I went to school in the Midwest, and small, not a big school. And when I came out in '73 and wanted to go to Wall Street, it wasn't an easy thing to do from where I was at. So I took whatever I could get to get into investments. And I was out in Indiana. Indiana at that time had countywide branching in banks. You couldn't have statewide branching. You couldn't, so you had. So I went to the largest bank in my county, in the town I was going to school in. The largest county bank there had an investment department. One-man shop. He wanted to make it a two-man shop, so I got hired. The best thing I could do, because I was given responsibilities very early on. I was doing asset liability stuff for the bank, so I was doing both trust work, which meant stocks, and investing for people, but also bank work, which was the bond side, and asset liability. That we had an asset liability committee, and I was sitting in on that at 22 years old, and so I had great exposure to kind of stuff that turned me into a real macro guy early on. Spent 4 years there, went to school at night in Chicago, so I'd leave Northwest Indiana, grab a Big Mac, and go into the Loop in Chicago at 6 o'clock at night. And it was a 3-hour class, and then be back home and go to work the next day. So I did that for 2.5 years, got my MBA, and then I, after 4 years, left there and went back to regional bank in Connecticut. That's where I realized how unique my experience was, because there, even though it wasn't a massive bank, it was large for the state of Connecticut, but it was you had to choose. You were either going to do bank portfolio or do trust, and so I did. I was more on the trust side then, and from there, where my career kind of took off, is I took a job with Textron as their in-house equity manager. This is an interesting story in that it was 1981. They had been beat up in the 73-4 market because their pension funds were invested in the New York banks. G. William Miller was chairman of Textron. At the time, he went on to be Fed chairman under Jimmy Carter, and in my opinion was the worst Fed chairman in history. But he was a very smart financier. Textron was the original conglomerate, so they were doing private placements and all kinds of stuff as a conglomerate. They were buying up other companies. So they, when their portfolios in the banks during the bear market went down, and he said, I got guys close to retirement, and I have to tell them their pension assets are in half. He goes, I never want to do that again. So he pulled all the money out of the banks, brought it in-house, and they ran in their pension funds like they ran their company. It was private placements, bonds, and a little bit of equity. But then they missed the oil market in the late 70s, early 80s when, and their top quartile performance in the time they had brought it out of the banks dropped to 50 percentile. So they said, we can't be out of equities. We missed, it's hurting our performance. So I was brought in, I was, barely 30 years old, brought in to run their equities. They had 10% of their assets in equities. And in the next 4 years, I showed, and G. William Miller had left there to go to the Fed. So he was not there when I got there, but his ghost was there. So I went to investment committees, and this was I joined them in December of 81. I told them to keep their powder dry until August of 82. I went into an investment committee and said, it's time to go. And we were at the bottom of the market. They had 10% of their assets in equities, and it was almost private placement equities. They were, value things that were out of favor and not really traded much. I started building a portfolio, and I went to them and said, can we put 100 million into the market? And they gave me a 50 million. And I came out of that meeting upset. My boss said, you don't know how lucky, that's a big step for them. And they're preaching to me the ghost of, G. William Miller said we should never do this. We need to be careful here. To make a long story short, over the next 4 years, I had top 1 percentile, 4.5 years, top 1 percentile performance for all those years in the pension fund index, the SEI pension fund index. I was top 1 percentile. Outperformed the indexes by 700 basis points a year, and took them from 10% equities to 50%. Their pension portfolio doubled in that time because they had done an acquisition. So I had, all of a sudden they didn't know what hit them. I mean, it was only the performance obviously made it easier. But I mean, they had never, ever intended to go equity strong like that. But it was the performance was so off the wall. So I went from there, leveraged me. I went from there to Fidelity. I was worked in Fidelity when Peter Lynch was there. Oh, wow. Wasn't mentored by Peter, but I was, certainly one of the portfolio managers when he was there. I was on the international side. So I was running pension funds that were globally diversified, and Fidelity was kind of unique in this way. They had their local managers running the various. So they had a European. They had a couple guys based in Britain running the European part of the portfolio. People in Asia running or Australia running some of that. We were running the U.S. portion of global portfolios. So I had all foreign accounts. So I had British Leyland and Westland Helicopter and Rolls Royce and some Australian accounts were equivalent of their Social Security fund, and some banks in Japan, et cetera. So it was, I wasn't in the mutual fund area, but I was certainly, rubbing elbows with those guys too. And it was interesting because I was there through the 87 crash.
I was going to ask you about that, how you dealt with that.
I was fine because I was, I had a lot I was hitting, because of my value bet, I was buying a lot of things that were during that time in the, in the mid 80s. All of a sudden these things were, and some of them I was buying off, I was seeing them in charts and doing my homework, but they were things that were like Fruhoff and American Standard and things. And they were the raters were getting them. I wasn't buying them to be rated or anything. The leveraged buyouts were going after them and stuff, but I wasn't buying them for that. And all of a sudden, 87 hit, and those got hit. So that was a little bit of a tough time for a couple months. But generally, what I took away from 87 was watching Fidelity was growing like a weed at that time. They were the place to be. Everybody wanted to be at Fidelity, and they had come up with the sector funds. They were early on in that, and they had 25-year-old kids fresh out of business school running these sector funds because they brought them in to be analysts, and then as analysts they got to run sectors, their area. So these 25-year-old kids are talking to the chairman of IBM or General Motors or Microsoft, would have you, and then 87 hit, and I saw these kids who thought they were masters of the universe. I mean, they didn't understand the reason their performance was doing so well and they were doing so well was a bull market. And when their portfolios just got decimated, I mean, they were in tears. I mean, it was like it just was a real comeuppance. So they learned a hard lesson, and it was just because they were so new and so young and were handed responsibility so quickly. But anyway, that was just kind of, and then I went on to be head of equities, head of active equities at ITT Hartford, which became Hartford Insurance Group, and then was a CIO of a $1 billion money management firm in New York, and then the second half of the career was as a macro strategist. So it's been kind of a half money manager and half macro strategist. And I always say, having had that first half really makes me a better strategist because I actually had to manage money.
This podcast is for entertainment purposes only. Please do your own research or contact a professional advisor.